been a really interesting year for markets, and I guess, in some ways it's amazing how quickly 2025 has gone. The noise of the markets, what's happening with geopolitics. It's equally hard to believe that it's only been a little over 9 months since Donald Trump's inauguration, which sometimes feels like a lifetime ago. So it's a really interesting time. For most of last year, if I just go back a little, markets globally were fixated on when the US Federal Reserve would begin its monetary easing cycle. The first interest rate cut was in September 2024, and this pushed markets to highs at the time. However, following the election of Donald Trump, President Trump, expectations of accelerating inflation from tariffs put further rate cuts on hold, and the US Fed didn't cut rates again until last month, September 2025. But this, combined with the global frenzy in AI investment, has pushed US markets to all-time highs. Not alone, gold, Bitcoin and many other asset classes have followed this upward trajectory. The US now dominates global markets more than ever. It used to be circa 50% of global markets, it's now north of 70%. And the US is really at the epicentre of current AI and the tech investment boom. And the numbers themselves are quite frightening. But the top 8 companies in the US are now worth $22 trillion US. To put this in context, Nvidia alone at $4.5 trillion is about the same size as the German economy, which is the 3rd largest globally. The growth of many of these companies has been fueled by this rush of AI-related investment. According to JP Morgan, approximately 46% of the S&P 500, its market capitalisation, is now somehow linked to AI. Now, this has pushed the overall market valuations on a simple price-to-earnings ratio to levels not seen since the first tech boom back in the late 1990s. Now, where do we go from here? I mean, if history is any guide, the current technology rally may have further to run. So it's worth remembering, despite markets looking expensive back in the day, they doubled again between October 1999 and March 2000. And while we're certainly not suggesting that markets will follow that same trajectory, those who've followed markets long enough will recall how that all ended. So following this strong lead in the US, and this is for most markets around the world, Australian equities are also very strong. Similarly, trading around all-time highs. Yesterday was another all-time high in the Australian market, and we're up about 7% since June 30. Certain parts of the market have had amazing share price performance since that short-lived sell-off in April, which almost feels like April last year, following Donald Trump's Liberation Day tariff announcements. For example, stocks like Life360 up 300%. Gold stocks have nearly all doubled. So there's some pretty big moves in the Australian market in the last 6 months. In fact, even the broader market, the general market, has been a really strong performer. It's been a stellar period for equity investors, with the S&P ASX 200 index up around 50% in the last 3 years. Now, while we clearly want and do have some exposure, to these high growth and high quality, high multiple stocks, we do continue to diversify our portfolio, to maintain that balanced long-term performance, and also to deliver shareholders that relatively smooth and growing dividend profile through different market cycles. So with this in mind, our recent acquisitions have primarily focused on companies offering strong cash flows, complemented with a smaller selection of higher growth businesses in the early stages of their development. So we continue to believe one of the, trends is that commodity demand will continue to remain strong. Driven by increased spending on defence now, adding into the data centre build-out, and more importantly than the data centres is the electricity demand and transmission required to power them, continuing rollout of renewable energy assets. This is driving a lot of commodity demand globally, taking a little bit of pressure off, the demand that China has provided for the past 20 years. Also, the supply side is going to take longer and cost more to deliver than expected. and this should support higher commodity prices over the long term. So regardless of any shorter term impacts of increasing trade tensions between China and the US, and that can happen any day of the week, we do think the longer term trend for the existing producers is solid. So in line with that thematic, we've modestly added to our BHP and Rio Tinto holdings and also Worley. We've added to Amcor, Clarity Pharmaceuticals, which is a stock we've owned for a while now, Sonic Healthcare and CSL. And I'll come back to talk about CSL as it's a well-held stock in the market. Generation Development Group is a new holding for us, and that's benefiting from very strong structural tailwinds in the superannuation industry. And we've also made a modest pre-IPO investment in Firmus Technologies, which is a data centre company with intellectual property assets in liquid cooling. On the sales side, we've fully exited positions in GPT, Crisis Corporation and Helios. Helios was a disappointing investment after showing so much promise during COVID when it generated a lot of cash and got itself into a very good balance sheet position. With rich share price valuations, we've also recently trimmed our holdings in Eagers Automotive, which has just done what we think is a really good deal with a Canadian auto distributor, but equally the share price has doubled, and Lynas Rare Earths, and they're both up over 100% in the past 12 months. And we've also modestly trimmed our holdings in Macquarie and Wesfarmers. These are very small sales relative to the size of our holdings, and we still like these companies. CSL, though, has probably been one of the most hotly debated stocks, I think, in the Aussie market for the last couple of years. And it serves as a great example of how market sentiment and also emotion can influence share prices just as much, if not more, than earnings and growth forecasts. So I mentioned Helios. Globally, the healthcare sector was perhaps the most negatively impacted by COVID. In CSL's case, these effects were compounded by management changes, a couple of own goals, to be fair, and some failed R&D projects. And this led to a period of flat and disappointing earnings for perhaps the first time in CSL's history. Now, CSL's earnings per share is in the orange columns there, and I guess it had a relatively flat period for CSL. Adding to this, I guess globally, proposed reforms to the US Affordable Care Act, advocated by US Health Secretary Robert F. Kennedy Jr., are raising concerns about future health policy and how much these companies will be able to charge patients, I guess, in time. So healthcare company share prices globally have fallen, and this has added additional uncertainty. So what does this mean for CSL? So earnings per share have fallen slightly, but the forward-looking expectations, which are the bars on the right-hand side of the graph, and this is from the market, so we take them with a little grain of salt, I guess, but the expectations are positive, are still pretty robust. Historically, through time, CSL's traded at a pretty meaningful premium to the broader market, and that reflected its earnings quality, the consistent growth, and that is the red line above the blue line, so quite a premium. However, the market is now significantly discounting or not believing the earnings to the extent that for the first time really ever, CSL's forward price to earnings, or the multiple, the PE multiple, is below the market average. So the market is, I guess, wanting to pay less for CSL's earnings than other companies in the market. So I guess we think that is an opportunity. We think 2026 is still going to be a pretty complex and messy year for CSL. They've announced plans to demerge a division, Seqirus, with their influenza business. It's very cyclical. They've stepped away from their pre-COVID plasma guidance, the margins, and in addition, just last week, Chief Financial Officer Joy Linton resigned. So they have a lot going on. But despite these challenges, we do believe that the share price reaction is overdone, and we do expect CSL to regain investors' confidence and attention over time. So I guess lower earnings and higher stock prices have pushed the Australian market to record high PE ratios as well, and similarly, record low yields. Now, the market does look expensive versus history, and we're not disputing that it is, but we do think there's a couple of relevant points, supporting higher valuations in the market. We do think the quality of the Australian market has never been better, as in there are more growth-focused and capital-light companies that are less capital-intensive and much less cyclical. There's also a record number of stock buybacks currently supporting valuations, and just in the recent reporting season we had in August, an additional 17 companies announced new or extended buybacks, and that's another $8 billion of stock these companies will buy back on market, also supporting share prices. And mandated superannuation flows are at record levels. We've got strong employment, we've got population growth, and we've got increasing contributions, which went to 12% in July. And this is all continuing to help bolster the market. I guess as a result, though, the cash dividend yield for the S&P ASX 200 is now 3.2%, and that's as low as I guess we've seen. So this compares to the cash rate at 3.6, 10-year government bond is around 4.1%. So even including franking, which is only partial in an index perspective, Australia's equity market no longer provides quite the same yield it once did. So in this context, we believe Argo's investment appeal increases, particularly when compared to an Australian index tracking ETF or cash. So although both Argo and index ETFs offer extremely low cost exposure to the Australian market, their differences after that are quite stark. Notably, while the index dividend and franking levels have declined, we continue to grow our fully franked dividend. And based on the current share price and the 37 cents per share fully franked we paid in the last financial year, our cash yield is 4%, and when franking credits are attributed, 5.7%. So quite a meaningful difference to cash. Our portfolio turnover is low. Now we believe that's prudent in minimising tax leakage for shareholders. We have quite a lot of unrealised tax. That unrealised tax we have as investments is earning dividends. Otherwise, we do sell and we do turn over the portfolio, but we think excessive tax leakage to the ATO is not in shareholders' best interest. So rather than sort of pursuing a high turnover strategy to chase short-term index returns, we're a little bit more prudent. However, we would argue the positioning of the portfolio is quite active. 7 of our top 20 holdings are not in the index top 20, and 16 of the 80 holdings are not in the benchmark index at all. Stocks that we think have a great growth potential or are something different, even though they're not in the index. And we believe this portfolio positioning will deliver superior dividend growth and, in time, capital appreciation compared to the index. Although, we do acknowledge that achieving both at the same time is a challenge, and, we do manage the dividend growth and the capital appreciation. But with our current portfolio and franking balance, we're confident we can conservatively grow and sustain Argo's fully franked dividend. We believe this will become increasingly attractive in a lower yield world, especially against partially or unfranked alternatives. And we continue to believe that the fully franked income growth alone is a compelling reason to own Argo. So we think about, we're just about into AGM season. We'll have the banks reporting this week, which is a great bellwether for the economy. Corporate Australia is in pretty good health. We had a reporting season throughout August, and generally speaking, companies are managing the environment well on costs, revenue, and balance sheets are very, very strong. So these companies are being relatively well managed through a period of heightened uncertainty. There is some support from the previous interest rate cuts in the economy, and they will continue to filter through. And there's potential for a further cut on Melbourne Cup Day, November 4. Consumer-facing businesses should face improving conditions as lower interest rates begin to ease the cost of living pressures, and prices of fuel, shipping and imported goods have also fallen. The macroeconomic data reflects a pretty resilient economy. However, we think the biggest challenges and the outlook remains highly contingent on what happens offshore, to be fair. And we remain alert to the challenges, including the geopolitical uncertainties. As we've seen in the past fortnight, renewed tariff tensions between the US and China particularly, once again spooked the markets. I mean, even if it was only for one day. But that sort of happened just as it appeared that the major tariff-induced volatility was behind us. So given that there are still, we think, a lot of global risks persisting out there and the valuations remain stretched, we continue to take a pretty conservative approach to managing the portfolio. And in this environment, I continue to sort of highlight the defensive and diversified nature of Argo's portfolio, which are attributes that help ensure our portfolio is less susceptible to sharp market swings, if and when we do get one. I'd also like to acknowledge and thank all of the Argo staff. It's a pretty small team, all fully committed to the company's success and for shareholders and across the two offices. All of the Adelaide office you've probably seen this morning. Also like to acknowledge and welcome Peter Warne as the new chairman of Argo. I've enjoyed working with him this year, and I also acknowledge all of the non-executive directors, and I look forward to working with them as we best navigate Argo through the next period for you, the shareholders. I'd also like to particularly thank Chris Cuff for his contribution to Argo as a board member. It's been a great pleasure for me personally, debating markets and stocks with him, and I'll miss your inputs and market feels, so thanks, Chris. And I do wish you well in all your future endeavours. And on that note, I'd also like to congratulate and welcome Simon Parish to the board, and I look forward to continuing the strong relationship that I and the whole executive team and staff have with the Argo board. I'd like to wish you all well, even though it feels like there's a bit of the year to go. Once we hit Melbourne Cup, that's it. It's a bit of a slide straight through to Christmas. So I'd like to wish you all well for the remainder of the year. We thank you for your continued support, for coming along today. Equally, coming to the roadshow that's becoming a bit more of an event, which we do in May, and I look forward to seeing you there next year. So thanks very much.